Hello everyone from Trading School. We are with you again with a new video. Today we're going to tell you about candlesticks patterns. It is said that the Japanese used technical analysis to trade rice in the 17th century. Munehisa Homa, a rice trader, is alleged to have shaped his trade by recording prices that oscillated throughout the year. Since Homa's trading strategy was based on understanding the psychology of traders in the market, it meant that he had to see what the price of rice was every day. So, he could see if the price action of that day were causing a candlestick pattern to form. Because of this, he is considered the father of the candlestick chart. So why are candlesticks so important? Candlesticks are at least as important as other technical analysis methods such as chart patterns, indicators. In times of indecision when trading, sometimes a candlestick will make your job much easier. Like chart patterns, candlesticks have a language and tell traders many things. So, what information can we have by looking at candlesticks? Open, high, low, and closing values of prices. Whether there is instability in the market. What is the trend direction? Whether there will be a trend reversal. Volatility, volume, and momentum, and many more can be learned. So how are candlesticks formed? Candlesticks consist of opening, high, low, and closing values. The green candle occurs when the closing value is above the opening value. The red candle occurs when the closing value is below the opening value. The highest level of candlesticks refers to the high value seen during the period, and the lowest level refers to the low value seen during the period. The area between the opening value and closing value is known as the body or the actual body. The extensions below or above the body are given names such as shadows, needles, wicks. The wick shows the highest and lowest traded prices of a security during the relevant period. A reminder: not always the shadow, needle, or wick of the body is formed. Even the body in some cases can form in the form of a horizontal line. Candlestick chart example is as in the image. It is possible to divide candlestick patterns into two: simple candlestick pattern and complex candlestick pattern. Simple candlestick pattern refers to patterns consisting of a single candlestick. Complex candlestick pattern refers to patterns consisting of multiple candlesticks. In this video, we will explain the simple candlestick pattern. Now we can move on to the details of these patterns. Big green candle. It has a wide range between opening and closing values and an unusually green, elongated body. Prices open low and close high. It is considered a bullish pattern. Big red candle. It has a wide range between opening and closing values and an unusually red, elongated body. Prices open high and close low. It is considered a bearish pattern. Doji is a model commonly found on candlestick charts. It is formed when the opening and closing prices are the same. It is characterized by being tall. But the length of the shadows may vary. Dojis are a sign of market instability. A doji is not that important if there is no clear trend in the market. Because non-trending markets are naturally an indicator of instability. If the doji is formed in an uptrend or downtrend, this is normally seen as meaningful. It can be thought that buyers lose faith when it occurs in an uptrend, or sellers lose faith when it occurs in a downtrend. A doji formation within an uptrend does not mean that sometimes price movements will reversal. In such cases, buyers and sellers are equivalent. The trend continues in the same direction with buyers eventually prevailing. The example of doji, which does not affect the trend, is shown in the image. As can be seen, although the doji was formed, prices continued to rise. The same rules apply in a downtrend. In such cases, it would be more correct to see the confirmation candle for trading. The confirmation candle is the signal candle that forms after any candlestick. Long-legged doji. A doji with a very long upper and lower shadow. This Doji reflects a great ambivalence about the future direction of the financial asset. An example of long-legged Doji is shown in the image. When it is seen at the top of the price movements, it is considered a bearish signal. Dragonfly Doji. It occurs when the opening and closing prices are at the highest level of the current period. If it has a lower shadow, it tends to move higher. When it is seen at the bottom of the price movements, it is considered a major bullish signal. An example of a Dragonfly Doji is shown in the image. After the formation of the Dragonfly Doji, it is seen that prices rise. Gravestone Doji. It occurs when the opening and closing prices are at the lowest level of the current period. If it has a longer shadow, it tends to decline more. When it is seen at the top of the price movements, it is considered a major bearish signal. An example of a Gravestone Doji is shown in the image. After the formation of the Gravestone Doji, it is seen that prices fall. Hammer. A red or a green candlestick that consists of a small body near the high with a little or no upper shadow and a long lower shadow. It is considered as a bullish pattern during a downtrend. Whether the body color is red or green does not change the expectation. The candlestick is called by this name because it looks like a hammer. Because it has an elongated lower wick and a short body. On the body may be a small upper wick or not at all. Most traders believe that for a candle to be a valid hammer, the lower wick must be at least 2 times or 3 times larger than the candle body, and the body of the candle must be at the upper end of the trading range. An example of the hammer is shown in the image. After the formation of the hammer, it is seen that prices rise. Hanging man. The hammer is the same as the candlestick. The difference is that it is seen during the downtrend. It is considered as a bearish pattern during an uptrend. The lower shadow should be 2 or 3 times the height of the body. Most traders believe that for a candle to be a valid hanging man, the lower wick must be at least 2 times or 3 times larger than the candle body, and the body of the candle must be at the upper end of the trading range. An example of the hanging man is shown in the image. After the formation of the hanging man, it is seen that prices fall. Inverted hammer. It consists of green or a red candlestick in an upside-down hammer position. It is considered as a bottom reversal signal that needs confirmation on the next candlestick. In other words, it is a signal that there will be a rise in prices. Most traders believe that for a candle to be a valid inverted hammer, the top wick must be at least 2 times or 3 times larger than the candle body, and the body of the candle must be at the upper end of the trading range. An example of the inverted hammer is shown in the image. After the formation of the inverted hammer, it is seen that prices rise. Spinning top. It has a small green or red body, which is in the middle of 2 long wicks. The length of the wicks may vary. It is seen in unstable markets where buyers or sellers cannot dominate. It is interpolated as a neutral candle but becomes more important when it is part of other formations. When seen in the overbought zone or oversold zone, it can be interpolated as a reversal pattern. An example of the spinning top is shown in the image. Long lower shadow. Under a green or red body, it is the formation of an elongated shadow. This shadow has a length of 2/3 or more of the length of the candle. Normally, the price is considered a bullish signal when it is seen around the support levels. An example of the long lower shadow is shown in the image. After the formation of the long lower shadow, it is seen that prices rise. Long upper shadow. On a green or red body, the formation of a long shadow is formed. This shadow has a length of 2/3 or more of the length of the candle. Normally, the price is considered a bullish signal when it is seen around the resistance levels. An example of the long upper shadow is shown in the image. After the formation of the long upper shadow, it is seen that prices fall. Green Marubozu. In some cases, the candle consists only of the body. The current trading period is dominated by buyers. There is little or no shadow formation above or below. Such formations are called Marubozu, which means Marvo diagram in Japanese. The trend is interpreted as a continuation pattern. In other words, if the Marubozu color is green, it is thought that the prices will rise on the next candlestick. An example of green Marubozu is shown in the image. Red Marubozu. In some cases, the candle consists only of the body. The current trading period is dominated by sellers. There is little or no shadow formation above or below. The trend is interpreted as a continuation pattern. In other words, if the Marubozu color is red, it is thought that the prices will fall on the next candlestick. An example of red Marubozu is shown in the image. Shooting star. It consists of a green or red candle with a small body. It has a long upper shadow. It may have a short lower shadow, or it may occur without a shadow. A shooting star, which looks like an inverted hammer, occurs in uptrend trends and is considered a downtrend. An example of the shooting star is shown in the image. After the formation of the shooting star, it is seen that prices fall. We have come to the end of our video here. The candlestick patterns described so far were patterns consisting of a single candlestick. Don't forget to watch our next video for candlestick patterns consisting of multiple candlesticks.